Imagine trusting someone with your life savings. Someone who speaks confidently, shows you charts, introduces you to successful investors, and promises your money will finally start working for you. Now imagine opening your account one day and realizing it is all gone. No profits, no balance, no explanation. This is exactly what happened to more than 300 investors in one of the most shocking financial frauds in recent years. Over $50 million vanished. Families were wiped out, retirements were destroyed, and at the center of it all was a man who appeared to be a financial genius until everything collapsed. This is the story of how a modern Ponzi scheme operated in plain sight, how intelligent people were drawn in, and how the same type of scam is still happening today. The perfect setup. The scheme revolved around two investment companies, Next Level and Yield Wealth Ltd., both controlled by a charismatic operator named Paul Regan. On the surface, everything looked legitimate. The companies had professional websites, polished presentations, and corporate-style offices. Regan presented himself as a sophisticated fund manager with insider strategies that ordinary investors could not access. His pitch was simple and seductive. He claimed to have access to exclusive trading methods that could generate 15 to 20% returns every month. Not per year, per month. He framed this as private wealth management rather than risky speculation. According to him, this was not gambling in the markets, it was precision investing. The story began in 2022. At first, Regan targeted semi-professional investors, small business owners, property investors, and financially literate individuals. These people had money to invest and understood basic finance, which made the operation seem even more credible. If experienced investors were comfortable, why shouldn't everyone else be? Soon, everyday savers were brought in as well. Teachers, engineers, retirees, and families trying to build a better future. Many invested not because they were greedy, but because they were hopeful. Why the returns seemed believable. One reason this scheme worked so well is that Regan did not promise absurd overnight riches. He did not claim to double money in a week. Instead, he promised steady, professional growth. A 15% monthly return sounds aggressive, but not impossible to people who have seen stories about hedge funds and crypto traders. He framed the returns as the result of advanced strategies, algorithmic trading, arbitrage, and access to private deals. Most investors did not fully understand these concepts, but they sounded technical enough to discourage deeper questioning. Complexity created authority. Regan also spoke the language of discipline and risk management. He claimed that losses were minimized through diversification and insider knowledge. He didn't behave like a loud internet guru. He acted like a conservative financial professional. That image was critical. How the Ponzi structure worked. At the beginning, everything appeared to function perfectly. Early investors received small but regular payouts. Some were paid monthly, others were paid quarterly. These payments created powerful social proof. People shared their success stories with friends and family. This is the core mechanism of every Ponzi scheme. There were no real profits, no secret trading system, no sustainable business model. The money paid to early investors came directly from newer investors. Fresh deposits were used to fund withdrawals. On paper, everyone was earning. In reality, the system was slowly hollowing itself out. Regan encouraged investors to bring in others. He framed this as helping friends access a rare opportunity. Many people unknowingly recruited their own families into the scheme. Entire social circles became financially entangled. By mid-2023, the operation had attracted over 300 investors and accumulated more than $50 million. Most of this money never touched legitimate investments. It flowed through company accounts and into personal spending. The illusion of success. Regan carefully maintained the appearance of wealth and competence. He traveled frequently, drove luxury vehicles, and hosted meetings in upscale environments. Success itself became marketing. When investors saw his lifestyle, it reinforced the belief that the system was working. They assumed he was wealthy because he was a brilliant investor, not because he was living off their money. This psychological effect is powerful. People judge credibility based on surface cues. Expensive suits, confident language, and visible success trigger trust. Behind the scenes, however, the structure was fragile. Ponzi schemes require constant inflows of new money. The moment that inflow slows down, the system begins to collapse. The red flags that were missed. In hindsight, the warning signs were clear. First, the returns were unrealistically consistent. Financial markets do not move in straight lines. Any system that claims steady double-digit monthly gains with low risk violates basic financial reality. Second, there was no genuine transparency. Investors did not receive audited financial statements. They were shown internal reports controlled by the same person handling their money. There was no independent verification. Third, investors were encouraged to recruit others. Legitimate investment funds do not operate like membership programs. When an investment depends on constant new participants, it is structurally unstable. Fourth, questions were subtly discouraged. Skepticism was framed as negativity. Doubters were told they simply did not understand advanced finance. These are classic Ponzi signals, yet they were ignored because trust had already been established. The beginning of the collapse. By late 2023, the flow of new investments slowed. Economic uncertainty made people cautious. When fewer new investors joined, the scheme's internal cash flow weakened. Withdrawals began to take longer. Payments were delayed. Excuses appeared: banking issues, regulatory checks, temporary liquidity problems. This is the final phase of most Ponzi schemes. As pressure increased, Regan could no longer maintain the illusion. Payouts stopped entirely. Communication became inconsistent. Investors panicked. Some attempted to withdraw large sums, others demanded documentation. The internal structure cracked under scrutiny. Exposure and investigation. Authorities were eventually alerted. Financial regulators began investigating the company's accounts and operations. What they found was devastating. There were no real investment activities capable of generating the promised returns. Money had been recycled between accounts to simulate performance. Large sums had been spent on personal luxuries. The scheme was formally exposed. Assets were frozen. Court proceedings began. More than 300 investors were confirmed victims. Some had lost their entire life savings. Others had taken loans or sold property to invest. The emotional damage was as severe as the financial loss. Paul Regan now faces multiple charges, including fraud and conspiracy. But for many victims, justice cannot restore what was taken. Why smart people fall for these schemes? This case demonstrates a critical truth: Ponzi schemes do not only target the naive. They succeed because they exploit human psychology. Trust spreads socially. When friends invest successfully, skepticism drops. Authority signals override logic. Complexity masks deception. Hope weakens caution. Scammers do not sell lies directly. They sell confidence. Once emotional commitment is formed, contradictory evidence is ignored. By the time reality becomes unavoidable, it is usually too late. The broader pattern. This scheme is not unique. Variations of the same structure appear every year under different names: crypto funds, real estate pools, AI trading systems, private investment clubs. Technology changes, but the structure does not. Money flows in. Early investors are paid. Trust spreads. Growth accelerates. Inflows slow. The system collapses. Every Ponzi scheme ends the same way. Lessons for investors. The most important lesson is simple: consistent high returns with low risk do not exist. Any investment claiming otherwise should be treated with extreme suspicion. Always demand independent verification. audited financial statements, regulated platforms, third-party custodians. If transparency is missing, walk away. Never invest under pressure. Urgency is a manipulation tactic. Legitimate opportunities remain valid tomorrow. Finally, understand that recruitment-based investing is a structural warning sign. If an investment depends on constant new participants, it is not investing, it is redistribution. Closing reflection. The $50 million Ponzi scheme run through Next Level and Yield Wealth Ltd. shows how easily financial illusions can be built and how brutally they collapse. More than 300 people trusted a system that was never real. This is not just a story about fraud. It is a reminder that in finance, skepticism is not cynicism. It is protection. Schemes like this are not disappearing, they are evolving. The question is not whether another will appear, but whether the next group of investors will recognize it in time. If you found this breakdown valuable and want more real investigations into scams and hidden financial traps, make sure to like and subscribe. It helps the channel grow and ensures you never miss the next story. See you next time.